What's up, everybody? Welcome to a kind of impromptu live stream here in my office. And a lot of questions came through after my recent video went pseudo viral about the Econ Major Explained series that I love doing. By the way, it's one of my passions, talking about macroeconomics and whatnot, given that was my major, my undergrad major, and really interested in, or there has been a big interest in alternative assets. And I've talked about this many a times on past live streams on this channel, but by far and away, other than, the concept of a lot of the things that are happening on the political spectrum right now that I like to talk about on the channel from time to time, in terms of the economic effects that are going on. A lot of people have been asking about investing in websites. And before we dive in, the link to the course that I partnered with flippa.com, the marketplace for buying and selling websites. I partnered directly with Flippa on that, and I'm going to be speaking at the event that they're holding on November 1st called The Exit. I'll be speaking on a panel in LA with them and their team. Fantastic company, love that marketplace. And the link to that course, as well as the conference, The Exit, will be in the description below. So definitely go show them some love. Would love to see you guys on that course. And next, I need to talk a little bit more about the title of this video and why people have been reaching out. So I've done multiple videos, semi-series, I guess you could call it, on buying and selling bad and good websites and how to differentiate and really parse out the ones that are good and figure out which ones are good and bad. So when you're presented with a group of websites, I've gone through videos in the past, you guys can check it out on the channel, I'm not going to go into that. But a lot of what I'm doing is something in the investor space, if you're brand new, called diligence. And when you're doing due diligence on a company or any sort of asset, whether it's private equity or hedge funds, real estate, whatever you're doing your diligence on, it's important to realize that you can only invest things that you're comfortable with losing, no matter what the asset class is, especially in an alternative asset class. Just assume that you can go on in your regular day life. You can keep doing your regular day routine without the money that you're investing. That's how I always look at it. Think 30 years out, and that's when you can reach the money again. So now that the mindset thing is taken care of, real quickly, I just totally brushed over that. I want to talk about the actual types. And I pulled up on my laptop here, if you see me looking over here, how the participation is broken down by the institutional investors. And I did this specifically because the smart money, as it's called, retail money or dumb money, is what it's referred to on Wall Street, which is me. I'm considered dumb money. Every mom and pop out there investing money in stocks and bonds and trying to figure things out on their own is considered dumb money by Wall Street. I don't think that's the case. That's just how it's labeled, unfortunately. But the smart money, quote unquote, of the institutional investors has a breakdown by asset class, and it's considered an alternative asset class because they'll only allocate a certain percentage. So the proportion of institutional allocating to each alternative asset class. So 16% are allocating to just one, 2% are or 15% are allocating to two, 18% are allocating to three different asset classes. Looks like 4 is 13%, 5 is 9%, and 6 alternative asset classes is 7%. And then none at all is 21% of institutional investors. So that is a little bit, it doesn't tell you that much, because 21% saying 21% of institutional money hasn't gone into alternative investments just means that they're just investing in traditional things like stocks. So what we'll go through now is the percent breakdown of the ones that have actually invested. So the ones that have one or more, of the alternative investments in their portfolio. We can break that down real quick. Also, I'm going to be putting the link to this in the description below so you guys can also check that out as well, because I'm just going to be spouting these off and I want you to see the graphic that I'm looking at and the post about it. So 58% at private equity. So the proportion of institutional investors allocating each alternative asset class. So 58% of their allocation is going towards, looks like private equity. 55% invest in the, what is this? So it looks like it's completely all over the place. Okay, so it's the actual, in each asset class. So each asset class, how each institution is, how much they're putting in each asset class. So like in terms of if real estate is 100%, the amount that institutions are putting into that overall is 55%. So I see here, little confusing with their numbers, as is many financial instruments and data. 55% in hedge funds, 63% are investing in real estate, 32% of institutional investors are investing in infrastructure, 36% are investing in private debt. This is a very, very interesting alternative asset class that I'm involved in. I've talked about peer-to-peer lending. I started a business in it about 6 years ago. That was a success. We exited, and it was a wild ride, but that is a topic for another day. So 36% in private debt, meaning that they're putting out peer-to-peer loans or purchasing debt and whatnot that they're able to service. And natural resources is 43%. So 43% of institutional investors are investing in natural resources. And it is funny that it's considered an alternative asset class because they're talking about like oil and things like that. And I always initially thought of that as traditional, but in terms of Wall Street's definitions, that is not a traditional way about it. So that's kind of the quick breakdown. It goes a lot more in depth, but I just wanted to give you guys the high level of what institutions are actually doing when it comes to alternative asset class. None of these are websites because it's literally that cutting edge. Web properties are the same as real estate on the internet. Like when you're buying a website, you are buying a property that exists on the internet, and you are getting traffic to that property, whether that property is generating revenue through ads, through Amazon links, through a SaaS business, whatever it may be. There's always going to be a different way that a website is monetizing. It's just a different way of looking at real estate, web real estate essentially. So I kind of associate that with real estate in a way, but it's not even on the board. And in these types of cutting edge industries, things like crypto and stuff like that, where people are just absolutely, on the bleeding edge, I think that, as I said before, it's important to put money into a new asset class like this that is money that you can afford to lose. One of these statements that I always say is if you are in a tight spot and you really, really, really need to, get out of a distressed situation financially, put everything in a spreadsheet. Open up a Google shared spreadsheet. Put your P&L, if you know how to create a profit and loss statement, create a profit and loss statement for you personally, for your just personal expenses. Not your businesses if you have any or anything like that. Just create a P&L for yourself and go through your bank statements. And if you're in a bad situation, you will do it. You will go through your bank statements. You will organize your spending. And what you'll notice is you'll be able to see your expenses, track how much is being spent, what's being spent on, and just like you would do it with a business. And you'll notice that you'll see things in there that you can cancel. Like subscriptions are the biggest drain on a lot of people's monthly bottom lines. So immediately cut those off. If you're in a bad situation, I do it anyways regularly. If I'm not using something for 2 months, it's gone. And just constantly monitor that bottom line. And it will not only psychologically make you happier and feel better and feel more empowered and feel more in control, but you will be able to eventually, if you're investing in cash flowing assets, whether it's in rental properties or on these web properties that I talk about on the course and talk about on this channel a lot, it is a way that you can offset your expenses. If you're spending $5,000 a month for your household and you start really, really lowering your expenses and you start kind of piling up a little bit of cash on your monthly net income, then buy a web property. Obviously with a percentage of that money that you can afford to potentially lose. Buy a web property that generates $100 a month, $50 a month, something like that. Put $1,000 into it and acquire it, pay $10 a month in hosting, and make your cell phone bill covered by that asset. A great mentor of mine years ago told me, pick an expense and pick an asset and put them together. And when you put those two together, put them in a spreadsheet side by side and have your assets covering all of your expenses. And that is true wealth. I've said it many times on the channel, but if you can manage to offset all of your monthly expenses, you are free. If you have your assets covering your monthly burn, you are able to continue doing whatever it is that you want to pursue. And that is something that the uber wealthy do. That is something that everyone I know that is, dealing in 7 and 8 figure deals, and they are very well off all over the country, always operate on the expenses being covered by assets rule. That is a kind of like an Illuminati concept. It's been around since the beginning of time, since landlords existed. I think if you can hack your housing to the point where if you aren't paying rent, if you live with your parents, if you live with a loved one, whatever it is, if you can hack that, you can sock away some money pretty quickly and invest it and put the money to work. And that is what true wealth is when your money's working for you. That is wealth. It's not having $1 million sitting in a bank account, just not doing anything, because it's just paper. It's literally just vaporware. That money, if it's not working and gaining momentum and gaining interest or gaining, any sort of cash flow for you, it is in my opinion, not worth anything. It's going to go away. And hard assets coming into a recession, which I'm going to talk about in the next month or so on this channel. But looking down the barrel of a recession is scary. But hard assets like gold, Bitcoin, real estate, your basic hard assets that are strong, hard money that are going to be around for a long time. Think about putting money aside and putting money into those, because those are things that pump and stick around during recessions, because people panic. Recessions are basically just meaning that you need to be very frugal. You need to monitor everything even closer. And when you have your spreadsheet that we just talked about, and you're looking into alternative asset classes like these institutional funds are, like I just mentioned, your private equity, your hedge funds, your real estate, your infrastructure, your private debt, like peer-to-peer lending type things, your natural resources, like your oil and gas and things like that, and your crypto and your web properties, you're already ahead of the game. If you're just watching this, you're ahead of the game because you're thinking about your future. You're investing long-term. You're not thinking about quick make money overnight, because that doesn't happen. If someone is telling you that is happening, they're making money off of you. So it's important to just be wary of that. And that's pretty much it, guys. I don't really want to go down too many different topics. I've done that in the past, and I kind of go off on rants, especially when I do live. and people DM me and send me all these different questions, and I kind of jumble them together because this one was very much a Frankenstein of alternative assets as well as offsetting expenses with alternative assets. And I'm an alternative guy. I love alternative assets because you have to come up with clever ways of doing diligence on your own. And I think that they are the biggest hidden secret of the uber wealthy. And that is pretty much it for this episode. I'm going to be in LA on November 1st. DM me if you guys are coming to the Exit, the conference by Flippa. It's going to be really fun. I'll be up there on my Hawaiian shirt. I'm going to stream it on the channel here, or I'm going to try to. I don't know how the internet connection is going to be at the event and whatnot, but yeah, I'll be up on stage with some rock stars talking about selling businesses, buying businesses, and stuff like that. And we'll be plugging the partnership course that rolled out last month. So really exciting over the next couple of weeks here and months. Going to have a lot more great content for you guys coming out on the channel. And for everybody that's been DMing and asking questions, thank you so much for the support. You guys are awesome. Love you guys. And I will see you on the next live stream and video.